Sixth chapter name is foreign currency account in India and abroad. So ever have you a struggle with sending or receiving money in different currency, or have you felt the pinch of high fee and bad exchange rate? So let's break down how foreign currency and multi-currency account, right, can make your global transaction smoother. So let's get started with the first point, that we have the key asset for global operation. So what does it mean? It simply means that these accounts help business and individual dealing internationally by reducing reliance on single currency. Yes, so local currency or single currency, right? Reliance on this is reduced, right? And these accounts, that means foreign currency account. So these help business and individual. You can see they help the business and individual, right? They can deal internationally, right? They can engage in international trading by reducing reliance on single currency. For example, suppose you are a US company, right? So you are a US company and you are buying supply from Germany. Okay, you are a US company and you are buying supply from Germany. So instead of converting dollar to euro every time, right, and losing money on fee, what you will do, you will keep euro in the foreign currency account. So it will save your time as well as your cost, right? So you are a US company and you are buying supply from Germany. So instead of converting every time dollar to euro, right? So obviously your time will also be consumed, and fee you also have to pay. What you will do? You will maintain euro in the foreign currency account, saving time as well as the cost. So that is called key asset for global cooperation. You are now you can understand why it is key asset for global operation. Then comes optimizing international transaction. What does it mean? It means that this foreign currency account protect you from sudden currency value swing. Yes, you know it very well, that currency value swing. So it protect you from sudden value swing, right? It protect you from sudden value swing and make cross border payment quite easier. For example, suppose euro drops in value next month. Suppose euro drop in value next month. So your pre-hold euro in the account still cover your Germany supplier bill. No last minute panic. So this is how it is helpful. Foreign currency account is helpful. And this foreign currency account is indispensable for businesses. Why? Because it ensures faster payment, as you can see, faster payment, then real-time exchange rate, then lower fees. So all of these reason, like faster payment, real-time exchange rate, lower fees. So it means your global client is happier. All these factors ensure that your global client is happier global client and supplier. For example, a UK designer working with client in Japan can invoice in yen directly, avoiding conversion delay and extra charges. That is why it is indispensable for business. Then come borderless and convenient. So what is the meaning of this term? Borderless and convenient. Have a look. So basically in this case, what is happening? One account, multiple currency, right? One account, multiple currency. So no need for separate account in each currency. For example, a freelancer in India. Suppose there is a freelancer in India. So he get paid in dollar, he get paid in euro, he get paid in GBP. Okay, so instead of three different bank, one multi-currency account hold all the three with single IBAN, right, for easy transfer. And then we have better financial control. It means that it simplifies tracking and managing money across currency, right? So tracking gets simplify, and also managing money also gets simplified, right? For example, suppose a traveler is there, okay, and that particular traveler, he can hold dollar, he can hold euro, he can hold pound. So in one account, right, switching between them when rates are favorable, no more losing money at airport exchange, right? So that is the point. So suppose let me give you one real life example of this. So suppose Sarah is a person, okay, and who run an online store. So she has an online store, and basically in the online store she sell handmade goods worldwide. So she has a multi-currency account. So with multi-currency account, she accept payment in dollar, she accept payment in euro, she accept payment in GBP without extra fee, and she pays her international vendor directly from the same account, avoiding bank hassle. The result is that more profit and less stress. I hope that makes sense to you. Now friends, let's recapitulate what we have just covered. So first point I told you that cut cost. So it avoid repeated conversion fee, right? Conversion fee get avoided. This is one of the biggest advantage. Second point I told you that save time. Save time means no delay in international payment. No delay in case of international payment. Third point I told you, it risk is get reduced. How? You can, because currency will move up and down, you know it very well. So you can shield yourself from this currency upward and downward movement. Then fourth point we talk about flexibility. So it means you can either hold, you can either send, or you can either receive multiple currency in one place. So these are the benefits of having this foreign currency account, FCA. So whether you are now have a look at the next point, that is another advantage of it, simplified transaction. So just we are talking about what are the advantages of this foreign currency account. So suppose you are tired of losing money every time you convert currency, or you are juggling multiple bank account for different currency. Let's talk about how foreign currency and multi-currency account make international payment cheaper, faster and way less stressful. First thing first, we have simplified transaction. It means these account cut down currency conversion fee. Yes, the cost of currency conversion get reduced. Okay, and it make managing money across border effortless. So simplify managing payment and transfer across different currency. For example, suppose you are a freelancer, you are getting paid in euro but live in the dollar. Okay, so a euro account let you hold and spend euro without converting them immediately. Then the next point, we have personal use flexibility. It means that it is not just for business, individual like expat, traveler, right? Traveler, student abroad who are living abroad, for them also they can use this account also. For example, a retiree, take the example of retiree, okay, who is living in Spain but receiving a pension in dollar. Okay, so he can keep dollar in their account and convert only what they need, avoiding extra fee. Then they enhance the transaction efficiency. It means that one account, multiple currency. This is the key benefit. You have just to maintain one account and multiple currency will be there. So no more juggling different bank for different country. For example, online seller in Canada, they get paid in dollar, Great Britain pound and Australian dollar. So instead of 3 separate account, they can use multi-currency account to receive, hold and send money in all 3. Then we have cost-effective global finance management. It means it save on transfer fee and exchange rate, right? You can see, so 2 kind of fee get saved. First of all, transfer fee gets saved. No more transfer fee, and exchange rate fee also gets saved. Though some account may have minor fee for certain service. So suppose you are sending $1,000 abroad. Suppose you are sending $1,000 abroad. So a multi-currency account might charge $5 instead of a traditional bank. Now, the next point we have is the centralized management. Yes, centralized management means what? You can think of it like a master wallet. You can think of it like, master wallet. Okay, with compartment for different currencies. No need for separate account in every country. That is called centralized management. For example, suppose there is a business owner. Suppose there is a business owner. He is dealing with supplier in Japan. He is dealing with supplier in Germany and India. So that particular business owner can manage yen, euro and rupee all in one place. Next point is wide availability. It means that you don't need a fancy offshore bank. Yes, you don't need a fancy offshore bank. No need. Many regular bank and digital platform offer these account, right? So even a small startup can open a multi-currency account online in minutes without visiting bank. So let me give you one real life example to make it more clear. So you can take the example of Raj. Okay, so this Raj, he is a digital nomad working from Bali. Suppose he is working from Bali. So his client pay him dollar, Great Britain pound and SGD. Okay, so instead of losing money on conversion, what he used multi-currency account. He used multi-currency account. Why he used multi-currency account? So that he can receive payment directly in each currency, so that he can hold fund until exchange rate are favorable, so that he can pay his rent in Indonesian rupiah without extra fee, and the result is that more money in his pocket and less hassle. So let's summarize what we have covered in this particular slide, recapitulate. I told you that holding multi-currency account means, one account, multiple currency. So it helps you save your time, save money. First point, it helps you save money. Second point, it save your time. Third point, global flexibility is offered. And the fourth point is easy access. So these are the benefits, right, of having this multi-currency account. I hope that makes sense to you. Now friends, in the next slide, we are going to talk about the growing need for foreign currency account. Yes, what is a growing need? Have a look. So imagine you are playing a game where the rules keep changing. That is what international business feel like without a foreign currency account. In our today's global marketplace, these foreign currency accounts are not just helpful, they are essential for survival. Let's break down why every business dealing across border need this one account. First of all, global trade necessity, which means that the world is more connected than ever and business must operate internationally to stay competitive. You're right, to remain competitive, the business must operate internationally. For example, a small coffee roaster in Brazil can now sell directly to cafes to Japan, but need a way to get paid in yen without losing money on conversion. That is why it is global trade necessity. Second point, it is vital for EXIM. You know what is EXIM? EXIM is export-import operation. Right? What it means? These accounts are like Swiss Army knife for importer and exporter. They handle all currency need in one place. For example, an Indian textile exporter. Suppose there is an Indian textile exporter, right? So he is getting paid in euros. So he can use a euro account to pay their Turkish fabric supplier without converting to rupee first. So this textile exporter is getting paid in euro. So he can use the euro account. Okay. What he can use euro account for? He can use the euro account to pay their Turkish fabric supplier without converting to rupee. No need to convert the amount to rupee. Rather, he can use euro account to pay their Turkish fabric supplier without converting to rupee. So that is why it is very vital for export-import operation. Then comes enhanced financial clarity, which means no more guessing games. So you can see all the foreign income, all the foreign expense clearly in their original currency, right? So you can see all kind of income and expense in their original currency. So it provide you financial clarity. I hope that makes sense. So for example, suppose there is a Canadian tech startup. So this Canadian tech startup, they can exactly track how much they are earning in dollar from US client, how much they are earning in dollar from US client versus how much they are spending in Great Britain pound UK developer. That's how it helps in enhancing the financial clarity. Then we have protection against currency fluctuation. Yes, very good. This is called currency roller coaster. It means currency value jump around. These accounts let you wait for good rate before converting. So for example, if the euro drops suddenly, so a fashion brand can delay converting their euro profit to dollar until the rate improve. So that's how it protect against currency fluctuation, right? So currency value jump around. So these accounts let you wait for good rate before converting. Then comes efficient cross border transaction. Yes, it means that money move faster with fewer fee when you are not converting currency constantly. Since you have a multi-currency account, so you are not converting the currency constantly. And since you are not converting the currency constantly, so what will happen? How it is helpful? So money move faster. Yes, faster movement of money, right? The faster movement of money is ensured. For example, a Malaysian electronic importer. Suppose there is a Malaysian electronic importer, right? So he can pay their Chinese supplier in yuan directly, right? Avoiding double conversion fee. So first of all, they have to convert Malaysian currency to dollar and then dollar to CNY. So this is avoided, right? So cross-border transaction become more efficient, faster movement. Then it is very much essential for modern EXIM business. It is not a luxury, it is a necessity as having a website for your business. For example, two competing furniture maker. Suppose two furniture maker are there and they are very much competing. So one with a dollar account for American buyer, right, saving 3% per transaction, will outprice the one using only local currency. So let me give you one real life example to make this concept more clear. So you can meet Sophia, right? So Sophia Spices, Sophia, not Sophia, basically you meet Sophia Spices. So basically it is a family business in Morocco, right? Exporting to Europe. They export to Europe. So before their euro account, right? They lost 5% on every euro to dirham conversion. They waited week for international transfer earlier, since they were not having the euro account. So what are the problem they faced? First of all, they lost 5% on every use because they have to convert euro to dirham, because they are exporting these spices to Europe. Then they waited week for international transfer, and also they could not predict profit due to changing rate. But after they get the foreign currency account, you can see price stay competitive, no hidden conversion cost, because everything is well known in advance. That is called price become competitive. Second point, they pay European supplier directly in euro, right? They pay European supplier directly in euro, and they know exactly when to convert profit for maximum gain. So that is the benefit of having the foreign currency account. So let's recapitulate why your business can't afford to wait. First of all, it helps them stay competitive. Stay competitive. I told you na that global customer expect a smooth transaction. Second point, it help in saving money, which means cut conversion fee and wait for good exchange rate. Third point, it reduce the stress, which means no more surprise loss from currency swing. Fourth point, grow faster, which means it handle more international business effortlessly. So in today's world, a foreign currency account is not just another bank product, it is your passport to global business success, right? Some more example advantage of this FCA for global trade: stability in currency exchange. So picture this: you are an international business superhero and your foreign currency account is your utility belt, protecting you from currency swing, cutting through red tape, and helping you manage money across border like a pro. Let's break down these superpowers. First of all, stability shield, right? You can see it here. What it means, it protect against a scary currency up and down. It protect against all these, right? Ups and down. For example, a Mexican exporter get paid in dollar. A Mexican exporter get paid in dollar. So suppose when the peso drops, their dollar earning are worth more peso, so crisis get averted. Then we have deal simplifier. As you can see, simplified trade agreement, deal simplifier. So basically when I say deal simplifier, it means no more surprise fee, no more surprise fee or last minute rate change messing up contract. For example, a German machine seller, he quotes 10,000 euro to a US buyer. Okay, so with a dollar account, they lock in the price without worrying about euro dollar swing. That's how it's helping simplifying the trade agreement. Then multi-currency mastering or multi-currency management. So what it means, that one account to rule all the currency. Yes, it gives the business the freedom to handle various currency with just a single account. Suppose, for example, a Dubai gold trader, they buy from South Africa and the currency of South Africa, ZAR. So they sell to India, INR, and pay expense in AED, all from one dashboard. Just it. That is the benefit. Then comes, digital agility, digital solution. So manage global money 24/7 from your phone. At 3 a.m., a Korean skincare CEO spot a weak yen, instantly converting profit to Japanese yen to maximize the value. So everything in pajamas. So some more advantages are there. You can see diversification. Yes, very important. So don't keep all egg in one currency basket. You know it very well. That is called diversification. For example, a Nigerian freelancer, he keep 30% earning in dollar as a safety net against Naira inflation. Naira is, currency of this Nigeria. Then borderless banking, cross-border seamless transaction. It means you can send, you can receive money globally like texting, right? So everything we have just discussed now, these are the benefits of having the multi-currency account. So let's just summarize the point. I told you about stability first, right? So having multi-currency account ensure stability. It sleep well despite market chaos. Second is the simplicity, which means contract without conversion headache. Third is the control, which means multiple currency, one holding, multiple currency holding. So it means you can hold, you can send, you can receive money in different currency all in one place. For example, a freelance designer in India, they get paid by US client in dollar, they get paid by UK client in GBP, and they get paid by Australian client in AS dollar. So instead of three different bank account, they can use one multiple currency account to collect, to hold, and to spend each currency as needed. Then saving on conversion cost, already I told you that avoid losing money every time, and every time you exchange currency, this thing we already discussed. Interest earning potential, yes, it means that some currency pay interest, so your foreign currency grow over the time, right? So like for example, a Singaporean investor hold dollar in their account, so the bank pay 4% annual interest, so $10,000 earn $400, 400 rupees, $400 every year for just sitting there. Then we have lightning fast, global payment, right? So you can send money abroad instantly without waiting for days and paying high fee. So that these are the benefit. I think we have seen several benefit. Now comes leveraging exchange rate for financial advantage. Let's switch our focus to this. Suppose you want to play the currency market like a pro without being a financial expert. Foreign currency account let you swap currency when rate are very hot, pay supplier faster, and keep all your global cash in one place. First thing is the currency switching. What does it mean? So it means that swap currency when exchange rate are in your favor. Yes, when you see that exchange rate are in your favor, so what you will do, you will swap currency in such case. Like an Australian wine exporter, he get paid in dollar. Okay. Suppose an Australian wine exporter is there, he get paid in dollar. So when the AUD, that is Australian dollar, drops, so they convert this dollar to AUD. So what they will do, they will convert the dollar to AUD, getting way more dollar for the same amount, because Australian dollar has dropped. So they will convert dollar immediately into AUD, so they will get more AUD for the same dollar. So that is called currency switching. Then comes all in one convenience, which means no more juggling multiple bank account for different currency every time we are discussing it. Now have a look at some disadvantage also. Yes, faster global payment is also there, but there are some downside also, that hidden fee can bite you. Some bank charges for conversion, withdrawal, just having the account open. These are the hidden fee. Suppose a Dubai investor is there, right? And he get hit with a 1.5% FX fee every time they convert AED, dirham to euro. Okay, costing them $1,500 on a 1 lakh dollar transfer. Right? I hope that makes sense to you. So friends, these are the weak points of it. That is, fees and charges are always included. Second is weak interest rate. Interest rate sometimes become weak. One more thing I want to tell you, minimum balance trap. Yes, this is another thing. Sometimes what happen, you should keep this much dollar parked or pay penalty fee. That is called minimum balance requirement. So a startup must maintain $5,000. I'm giving you example. I'm just giving you example. A startup must maintain $5,000 in their dollar account. So money that could have used for inventory. So that is called minimum balance requirement. This is another disadvantage or downside. And the lower interest rate. Yes. So your foreign cash earn little or nothing. For example, a French exporter, they keep THB in Thai account earning just 0.5%, while their euro saving account back home offer 3.5%. So these are the three drawback. So what we just know, that what we just come to know, that what you should do, you should switch currency, right? The basically the bottom line is that you should switch currency, right, when rate favors you, right, and consolidate account. So switch currency, and what should you do, you should consolidate account. And what you should avoid, you should avoid high fee. Yes, high fee should be avoided, and unnecessary minimum balance should also be avoided. And you should compare interest rate versus regular saving account. This you should compare. I hope that makes sense to you. Now, if you look at the type of foreign currency account that is available to us, now is a very important part, right? From here, questions are asked every year. So, did you know that as an Indian resident, right? As an Indian resident, you can hold dollar, euro, other foreign currency right here in India. So, whether you are exporter, freelancer, or just receive money from abroad, there is a foreign currency account for you. So, first of all, the first kind of account that we are dealing with is a regular foreign currency account. Okay, so for resident and non-resident, regular foreign currency account, as you can see it here. So regular foreign currency account means you can hold foreign currency in India or abroad. For example, an IT freelancer in Mumbai, he get paid $5,000 per month from a US client. So instead of converting to INR immediately, they keep it in USD account to avoid losing money on bad exchange rate. And you know, these are governed by FEMA. Yes, these are governed by the Foreign Exchange Management Regulation 2015. Now comes the first kind of foreign exchange account that we have, EEFC account, Exchange Earner Foreign Currency account. So the first question is who can open? So exporter can open, right? Professional can open, who is earning foreign income, like IT consultant is there, suppose. So he can open this account, right? For example, a Delhi-based fashion designer selling to Europe, they can keep euro in EEFC account. There are some key restrictions. The key restriction is that, so I think we have discussed who can open foreign exchange earner, individual, right? They can credit all their earning in the EFC account. And one more thing, that the balance must be converted to Indian rupees by the end of succeeding calendar month, with some exception. So that is the point. They must convert to INR within the next month. This is first restriction, with some exception. And they cannot receive money from other Indian. They can only receive money from abroad. Okay. You can see now, EFC account holder cannot receive payment from other resident or maintain foreign currency deposit abroad. That is the point. And no interest they are earning on it. This is just like current account. No interest on this account. Right? Your money just sit there. No loan or no credit against this account. Right? So basically bank cannot provide you credit. And EFC account cannot be opened if the RBI allow exporter to hold foreign currency account with bank abroad. This is very, very important thing. So what are the restrictions? First restriction is that you have to convert you have to convert the foreign currency into Indian rupees by the end of the succeeding calendar month. Second point, I told you that EFC account cannot receive payment from other resident, and you know, no interest. You will not receive any interest. No loan or credit against this account. And what are the currency allowed? Yes, dollar, Great Britain pound, euro, Australian dollar, and Canadian dollar. Bonus perk is that no minimum balance requirement. Yes, this is a good thing, right? No credit facility. It does not offer any kind of credit facility. So I hope every aspect about EEFC account is clear. Exchange under foreign currency account. The next kind of account that we have is the RFC account. That is a resident foreign currency account. For whom? Yes, the first question is for whom. So basically this RFC account is for NRI, non-resident Indian, who return to India. They can keep their foreign earning. Right, so he has returned to India, they can keep their foreign earning. For example, an engineer who worked in US for 10 years, right, and he saved $1 lakh, suppose. Okay, so when moving back to India, they open an RFC account to hold those dollars, so they can open it. So basically, let's just talk about the real life example to make it more clear. So you meet Priya. Okay, so Priya, you know, she is a Bangalore-based app developer with US client. So before, she lost 3% on every dollar to INR conversion. She lost this 3% before, earlier. After opening the EFC account, what happened? That she can keep dollar earning for 30 days. First point, she can keep dollar earning for 30 days. She can convert only when INR is weak. Only when she sees that INR is weak, she will convert dollar into INR. So she saved 1.2 lakh rupees per year in Forex loss. So that is the benefit of having EFC account. So let's recapitulate what we have discussed just now. We have just discussed the benefits of this EFC account. So the first point we talked about is the regular FCA account, regular foreign currency account. What I told you, they are best for holding Forex long term. They are best for holding Forex long term. Then we discussed about EFC account. So they are best for exporter and freelancer. Then we discussed about RFC account. So they are based for returning NRI. And DDA account, we will discuss it right now. So now have a look at the EFC account. I think we have discussed. Okay, some more key features are there for these two accounts. So suppose if you earn foreign currency, or suppose you are an NRI returning India, you have probably heard about these two accounts, EFC and RFC account. But which one should you pick? Let's compare them side by side with real example. First of all, EFC account. So joint account is allowed, which means you can add family member, but they can't operate it alone. Okay. So, farmer or survivor clauses will be there. Then comes, business friendly, which means, you can use Forex earning for trade payment without converting to INR. Right. So, with few capital account transaction allowed, and there is no restriction unless explicitly stated. Then comes, zero conversion fee. Very important. That you can pay foreign supplier directly in dollar. You can pay foreign supplier directly in dollar. You can pay in euro, or you can pay in Great Britain pound. That is called zero conversion fee. You can see it written here quite clearly, without any conversion fee. Okay, then comes no minimum balance, which means no pressure to maintain a fixed amount. Then comes multi-currency support. So you can hold dollar, GBP, euro, CAD, AUD, that's it. But you must know that you must convert to INR within 30 days. Yes, this is very important. So within 30 days, you have to convert to INR. No interest is earned on this account. Your money does not grow here. They are only for Forex earner, not for personal remittance. For example, a Mumbai-based software firm get paid $20,000 from US client. So instead of converting to INR immediately, they keep it in EFC account to pay their Google ad bill in dollar, saving 3% in conversion fee. What about RFC account? I told you they are for returning NRI. Already I told you. So you can keep your foreign saving when moving back to India. Yes, it offers you flexibility in terms of, you can use fund for investment, travel or remittance purpose. Right? So that is how it offers you flexibility. Multiple account type it can be. It can either be current account, it can either be saving account or term deposit account. So multiple account type. No forced conversion. Right? This is another advantage. Yes, no forced conversion means you can hold foreign currency indefinitely, but remember they are only for returning Indian former NRI, right? Not for regular earner, and they must be opened with the AD bank, authorized dealer bank. Not all bank offer it. Suppose after working in Dubai for 15 years, so Raj worked in Dubai for 15 years. After working in Dubai for 15 years, he returned to India. Right, with AED 5 lakh. So with AED 5 lakh he returned to India. So instead of converting it all up to INR, he opened an RFC account to keep his dirham for future UAE trip or investment. So let's summarize what we have just covered now. I told you about EFC account. So EFC account, just now I told you that this EFC account can be opened by exporter, it can be opened by freelancer, or it can be opened by Forex earner, right? It can be opened by Forex earner. But if we talk about the RFC account, it can only be opened by returning NRI. That's the difference. Second point I told you, holding currency holding. So here it is short term. You can hold the currency for short term, that is 30 days, because in the next month you have to convert into INR. But in the case of RFC, it is long term. There is nothing like currency holding. That's the difference. Then comes interest. What about interest? Do you get any interest on EFC account? No. What about RFC account? Yes. If it earn interest. If it is FD, if it is saving, it earn interest. In current account, there is no interest. That's the difference. And lastly, if we talk about the uses, so EFC account are basically used for business payment, Forex deal, and RFC account are basically used for travel, or investment remittance. That's it. So you should pick EFC account if you are exporter, if you are freelancer and want to avoid conversion fee. And you should pick RFC account if you are NRI returning to India and want to keep the foreign saving. That's it. Okay, eligibility we have talked about. Who can open this RFC account? Interest, yes, interest is received, as you can see. Interest rate are set by the bank. They offer some flexibility. Account type, I already told you, it can either be saving account, current account, FDR. And 5 major currency, these are available. What are the 5 major currency? Dollar, GBP, Euro, Canadian dollar and Australian dollar. Yes. What about the checkbook? Very, very important. So if you talk about the checkbook, RFC saving and current account do not come with checkbook. That is a very important point. Now, there is something called, opening balance. So a minimum balance of 100 unit is required for saving and current account with no interest if the balance fall below 1000 unit in any currency. So, minimum, I told you about, if it is saving and current account, minimum 100 unit, right, is required. And if it fall below 1000 unit, no interest is earned. For example, take the case of Arjun. So Arjun RFC saving, suppose Arjun RFC saving has $900. So he gets 0 interest that month because it fall below 1000 unit in any currency. So no interest for that. If balance fall below 1000 unit in any currency, no interest. This is very, very important thing. What about fixed deposit term? See, it is either 1 month to 3 year, right? That is the minimum tenure of 1 month. So if you want to open an FD account in RFC, you should have to operate it minimum for 1 month and maximum it can go up to 3 years. For example, Mina lock in euro 20,000 euro for 1 year at 2.5% instead of converting to INR immediately. Then joint account, yes. So basically you can add relative, but they can't touch money until you pass away. That is called former and survivor clause is there. Okay. So Vikram add his wife as joint holder, but she can't withdraw until he dies. Then comes, checkbook. No checkbook, digital transfer only. If you need to pay someone, you use net banking or wire transfer. No checkbook. So it is based for NRI with future foreign expenses, not for quick INR access. So let's recapitulate. What are the features of RFC account we have just gone through? First one, I talked about eligibility. So remember, these are for returning NRI only. I told you about currency. It can be dollar, it can be GBP, it can be euro, it can be CAD, it can be Australian dollar. So these are the different currency in which it can be done. Then we talk about the minimum balance. I told you 100 unit. 100 unit is the minimum balance. Then I talk about FD tenor. So FD tenor I told you 1 month to 3 years. Then we talk about joint account. Yes, joint account is permissible, but relative can't operate. Relative can't operate. And what about checkbook? Checkbook is not allowed. So these are the points. Now what about the diamond dollar account? Yes, very, very important. DDA, we call it DDA. So friends, did you know that diamond exporter in India can get a special dollar account to avoid currency conversion headache? So it is a very powerful tool for gems and jewelry businesses. So who can open DDA? First of all, have a look. So it is opened by diamond and jewelry exporter. Means either it is rough diamond or cut diamond. As you can see, rough, cut and polished diamond. Okay, studded jewelry. And then comes, a status holder. So first point I told you. Second point I told you, a status holder. Yes, you can see. A status holder, what does it mean? 100% export unit. 100% export oriented unit. They can open it. They are eligible. A status holder are eligible. Either EPZ means export processing zone, or STP means software technology park, or ESTP means electronic hardware technology park. Right? 100% export oriented unit in EPZ, STP and ESTP, they are eligible to open this DDA. Second point is, established trader. Established trader can also operate. Minimum 3 crore. Yes. So as you can see, what is the condition for established trader? So annual turnover of 3 crore for 3 years. So minimum 3 crore annual turnover for 3 years plus 2 years in diamond trade. Remember, question are directly asked. So annual turnover of 3 crore for past 3 years and minimum 2 years in diamond trade. So they can operate, but it is not for whom? Not for regular business and non-exporter or new startup. For example, a Mumbai-based Sparkle Gems. Suppose the name of the firm is Sparkle Gems, right? They export diamond to the USA. Their average turnover is 5 crore per year. Okay. Now they qualify for DDA to receive dollar payment directly, right? So they can, in this DDA, they can receive dollar payment directly. That's the point. Now the question is, how does it work? So have a look. First of all, USD only. It is only available in one currency, that is dollar, and only available as a current account, no interest earned on it. But it helps you save the conversion cost. No INR, no U. I told you na, in the previous case of RFC there were 5 currency which were allowed, but in this case only one, because name itself is a diamond dollar account. Dollar means what? Dollar only, right? And one more thing is that maximum 5 DDA can be opened by one firm. Maximum. Let me give you one example. For example, Royal Diamond, which is a firm in Surat. Okay, so it has 3 DDA. It has 3 DDA. DDA1 for US client, DDA2 for Dubai buyer, and DDA3 for bulk payment. But there are some restrictions which we have to know. First of all, no transfer between DDA. Intra-account transfer between DDA. So he cannot transfer from DDA1 to DDA2. This is not allowed of the same holder. Right? You can't move from DDA1 to DDA3 directly or DDA2 directly. Then the no interest, I already told you that money sit idle and strict eligibility. Right? So let's summarize, let's recapitulate what is the point which we have just covered now. We are just talking about DDA, you know. So purpose, I told you, purpose is very simple, diamond and jewelry export. Currency is dollar only. Interest, no interest. Minimum eligibility, I told you, 3 crore per year turnover plus 2-year experience. Then I told you about maximum 5 DDA account per firm. Then transfer not allowed. Transfer not allowed, right? Between DDA, you cannot transfer between DDA. Okay, so these are the point. Now there are some more restrictions, like credit and debit transaction, as you can see. Have a look. So friends, what if I told you that diamond exporter get a special VIP pass for dollar transaction? Yes, the DDA account let you move money in way regular account can't. But you have got to play by the RBI rule. First of all, money coming in, that is called the credit, that is called permitted credit. Have a look at which type of credit are permissible. First of all, export earning. So which means, when Mumbai Diamond sell 100, suppose Mumbai Diamond, they sell $100K of polished diamond to New York. Okay. So the payment got straight into their DDA. Payment will got straight into their DDA. So that is called, export earning. This is permissible. Okay. Then local diamond sale. What about the local diamond sale? Suppose you are selling cut diamond to another Indian exporter. So those USD payment can also go here. So it is not that only foreign currency, foreign exporter only credit. No, local diamond sale can also go to this amount. Okay, account. And suppose dollar loan, right? So if you take $200K pre-shipment loan, it get credited to your DDA. Yes, pre-shipment and post-shipment finance also get credited here. So pre-shipment and post-shipment finance proceed from sale of rough cut diamond and local sale of diamond. All these are credited to the DDA account, right? And currency is always dollar. And now let's look at the money going out. That is the debit. So you can buy the rough diamond. So you can see rough diamond buying, which means suppose you are purchasing $50,000 of raw diamond from Botswana. You pay directly from DDA. That is the money going out. Local purchase. Suppose you are buying gold jewelry from Jaipur supplier. So you can use DDA fund if paying in dollar. Yes, condition is that you are paying in dollar, because in this account only dollar currency is there. Then loan repayment. Can we use this account for loan repayment? Have a look. So suppose you need to repay that 200,000 loan which you have taken. So you can deduct it from DDA balance. And finally convert to INR. So you can transfer $10,000 to your regular account when you need rupees. So these are the permitted debit, right? There are some special feature that keep 100% Forex, which means no forced conversion to INR. So DDA account holder are allowed to retain 100% of their foreign currency in this account and access Forex market. If you need more dollar, you can buy separately without touching DDA fund. And then access to Forex market, which means if you need more dollar, you can buy separately without touching DDA fund. No minimum balance. I told you that keep $1 or $1 million, your choice. So there is nothing like minimum balance requirement. So what we have just covered, now let us recapitulate. We are talking about DDA account. So I told you what you can do. You can receive export payment. Export payment you can receive. You can buy raw material. You can hold unlimited dollar, or you can convert to INR whenever needed. So these things you can do. Now the question is what you can't do. So what you cannot do? You cannot earn interest. No. You cannot use for non-diamond business. No. You cannot transfer between DDA. Can you transfer between DDA? No. So suppose you have 3 DDA account. So you can't transfer between DDA. And you cannot pay for foreign vacation. Okay. So a smart exporter use DDA like a dollar wallet, keep enough for import, convert the rest when INR is weak. And obviously there is no minimum balance requirement. So it offers flexibility to the account holder. And that is all you need to learn from this particular chapter. Let's recapitulate all the points which we have gone through. Right, this will help us in revision. So first of all, I told you about the advantage of foreign currency account. It helps in cutting the cost, save time, risk get reduced, and flexibility get increased. Second aspect we have just discussed is that it save money, it save time, it provide you global flexibility and ease of access. Then in the third slide we talked about it help in cut down the competition, and then save money, reduce stress, grow faster. These are the advantages. And then we talk about stability, simplicity, control, speed, safety, every aspect. Then in the next slide what we discuss is some disadvantage of it. The downside, I told you that you should switch currencies, consolidation, but you should avoid high fee, minimum balance requirements. So this is a downside because fee are very much higher. Sometimes some hidden fees are there, minimum balance requirement is there, interest rate are quite lower. So these are the downside of this foreign currency account. Okay. Then in the next slide we discussed about regular foreign currency account where forex is kept for long term. Then we talked about EFC account, which is for exporter and freelancer, right? Then we talked about EFC for exporter, freelancer, forex, and in the case of EFC, currency is held for short term for 30 days. In the case of RFC is for returning NRI, and here currency is held for longer term. In the case of EFC, no interest is to be paid. In the case of RFC, interest payment is applicable. Then in the next slide what we talked about is the returning RFC account. RFC account is for returning NRI. 5 currency can be used: dollar, GBP, euro, CAD, Australian dollar, right? If you want to open an FD, minimum maturity is 1 month, maximum maturity is 3 years. Joint account is permissible with formal and survival clause, right? And relative can't operate the account, and checkbook is allowed. So these are the points which I have just talked now. Then in the next slide what we discussed about DDA account. So this is diamond jewelry exporter. For diamond jewelry exporter, no interest is given. Dollar earning only, in the currency is dollar only, right? So this should have 3 crore per year. 3 crore per year turnover plus 2-year experience, and 5 DDA per firm it can be maintained, and transfer is not allowed. Now DDA, what DDA can do? They can do export payment, they can buy raw material, they can hold unlimited dollar, they can convert to INR. What DDA can't do? They can't earn interest, they can't transfer between DDAs, they can't pay for foreign vacation. So these are the restricted no, and that is all.